I don't think that happens from a bunch of people saying like, oh, I want to pay for things in Bitcoin because I like Bitcoin. I think it happens from people over time saying, no, you need to pay me in Bitcoin. It comes from the person who's selling things and saying, you know, I could accept stablecoins and I could get this X% of interest. And then people are going to be like, well, yeah, I want Bitcoin because I've been watching it go to $1 million and I know that it's what's backing all these stablecoins I'm accepting right now. Why can't I just, you know, have it directly so they don't get all the money and I get some of it? So as the price of Bitcoin goes up, the value of the assets any sort of lending business is dealing with goes up. Its market just starts to grow. And then we also view that the percentage of lending in the market is a lot smaller than what it'll be naturally over the long term. And now that regulations change, it's like businesses can, banks can. And then it's ultimately something that's getting this whole new world that manages the most money in the world exposure into Bitcoin over time. Yeah, everything's fine. Bitcoin's going up. Seems like it's going to go up a lot more. And I'm excited for the rest of this year. How about you?
Absolutely. It's day one. And for the people that I might confused, we are releasing it probably a little bit later, but we're recording on day 1 of October and it's actually going up like what, 3%, 4%, something like that.
That's right. Yeah.
It's crazy how it is predictable. Maybe let's get started actually with that. What have you've been on, I think earlier this year, so like about like half a year to a year or something like that back. What kind of was the most exciting thing for you that you've seen this year so far?
Well, definitely for us, we put out a bank adoption report and we've been really focused on that question because I have a venture capital fund that focuses on investing in like Bitcoin infrastructure and things that are going to bring Bitcoin to more people over time. And that was one of the biggest questions on our mind at the beginning of the year was everybody's like, okay, regulatory environment in the US has shifted. And now that we have a favorable administration that's, you know, passed policy that's been very beneficial to Bitcoin, there was a specific regulation called SAB 121 that was repealed under SEC guidance. And that kind of changed the game for banks being able to make Bitcoin a part of their business in the US. So when that happened, we were like, you know, a lot of people were talking about, okay, the banks are coming to Bitcoin. The banks are coming to Bitcoin. And we're like, what does that actually mean? What are they going to do with it? What kind of services are they going to provide? So we ended up doing a whole deep dive into that through this report and answering that question. One, because it matters, you know, from our perspective as investors, the type of startups we invest in really matters a lot. Banks participate in all these different functions like lending and, you know, foreign exchange and all these other services that today companies that aren't banks are providing. So for us, we're like, what happens when the banks come in or like this new form of competition? And then two, what things are needed to ultimately like get these types of companies using Bitcoin in one way or another? Like the way that we view this is there are certain people and companies that will use a bank type organization no matter what. So the question is how do we get them exposed to Bitcoin over time? And we built out actually a really interesting thesis around how we think Bitcoin kind of Trojan horses, because a lot of people talk about that too. You know, they'll say like banks and stable coins are kind of like a Trojan horse for Bitcoin. And we kind of put together a much more practical thesis on what does that actually look like? How would that actually even happen in the first place? So I think that, you know, we spent the majority of the year kind of focused on that. We wrote this report with the former chief technology officer of Silvergate, and they built this technology network in the US called the SEN network, which is what all of the cryptocurrency exchanges were using to settle dollar liquidity amongst one another, basically until the whole, you know, industry blew up effectively. And it was Operation Choke Point 2.0 that, you know, kind of took Silvergate out back, and, you know, Biden administration basically took them out back and shot them. And, you know, they had a voluntary wind down. They didn't go bankrupt or anything, but they're just like, we can't operate in this type of an environment anymore. And now that regulations change, it's like businesses can, banks can. And yeah, so it's a really interesting question to us because we think it could be like one of the new vectors of adoption for Bitcoin over time. And it's ultimately something that's getting this whole new world that manages, you know, the most money in the world exposure into Bitcoin over time.
It's interesting because I just had yesterday discussion with Jesse Myers, like how he thinks like Bitcoin treasuries are actually like the a whole new wave. And if banking is something really interesting where this gives like a huge kind of leverage to that. Like I think in general we can say like TradFi coming into Bitcoin is huge, and them discovering kind of Bitcoin. I think we had like the first kind of small indication for that for when BlackRock came in, like the ETF kind of came in, but it's just like small toes in the water kind of thing.
Yeah, absolutely. So when people make this comparison with Bitcoin treasury companies and banks, it like a theoretical level, it kind of makes sense because they're holding a lot of Bitcoin, and then they're going to take the Bitcoin and they're probably going to go do something with it to earn some sort of rate of interest on it. We talk about that a lot in the report over time. Like in the real world, banks are a really hard thing to actually become, because what defines a bank versus anything else in the modern world is having a bank charter. And getting a bank charter is a really hard thing to do. And it's kind of a game that people with lots of money play. So, a world where we have a bunch of Bitcoin treasury companies getting like bank charters is probably not something, at least on the near term horizon. But companies that already have bank charters providing a Bitcoin solution is pretty near term on the horizon. And in the way that we kind of think about that is that like banks all think about their how successful they are based on their net interest margin, and you would kind of think about that in the range of like 2 to 3% today for any market rate on a bank. And when you get Bitcoin involved in your business model, that can drastically increase what your potential net interest margin is. And we expect that like a lot of smaller scale banks are probably going to start going this direction because there's money to be made. Once you understand the value of Bitcoin, once you understand it well, then you understand that it's not nearly as risky as you once perceived it. And then all of a sudden as a bank, you say, wow, this is a really valuable form of collateral. How can I make loans on this collateral? Oh, these loans are 10%, 12% interest right now. Okay, so I kind of understand Bitcoin now. I realize it's not nearly as risky as what the way people thought it was, and I'm going to structure my loans to work around its volatility, and I can get a really high interest rate off of getting into this form of lending. And we see that as kind of like the lowest hanging fruit market the banks will be moving into, and then they're going to realize the benefits of using things like Bitcoin and stablecoins to do cross-border payments as well on behalf of their clients, and that's a whole vector of revenue that's also going to be proliferating. I think that like when it comes to these the whole like thesis around what is going to make a bank different from everything else, and going back to the bank charter point, a bank charter just is your license to take depositor money and lend it, and like that is the cheapest form of capital in the world effectively. So like that's what banks have as a competitive advantage. Whether or not you agree with that is a separate question, but nonetheless, if you don't have a bank charter, it's going to be very hard for you to compete in these businesses over time. There's going to be markets that exist for it, but banks are going to start dominating these markets over time because it's really hard to compete against free money. And as long as the fiat world exists like that, they're going to have a pretty competitive advantage in terms of sourcing capital.
That's interesting. It's also I've had that discussion, I think like a year ago once, where we talked about banks versus central banks and kind of the differentiator, and then like what happens if central banks really push for like a digital currency that they control directly, kind of eliminating the banks entirely. Like of course, like not short term, but like long term, where like you just like have a bank account with like the ECB instead of like the local Austrian kind of a bank. It weirdly enough really incentivizes banks to look at Bitcoin of like, oh, if they go the CBDC route, like we should go the Bitcoin route, I guess.
Right. Yeah, no, it's a great point. Like there's a lot of decisions being made in the market right now. And there's these forks in the road that everybody's kind of going down. And your point about if we go this CBDC path, and if we're kind of, what you're describing is we're disintermediating what's happening within the banking system. And people can actually kind of start to go more direct. And that's what we realized is that this whole structure, like this whole two two-tier banking system that's structured. And what that means is, there's this huge flow in terms of how money gets created. It's like the Treasury Department issues debt, and we have prime brokerage type banks that are buying that debt, and then they are selling it to the Federal Reserve, and the Federal Reserve is allowing commercial banks, and then the Federal Reserve is effectively converting that as a reserve onto the balance sheet, and then commercial banks take that reserve, and then they can go lend into the market based off of that reserve. And it's this whole complicated process. It's just like, what the hell is even going on? And it doesn't appear to make much sense. And a lot of it's kind of built on just how regulations have been put up to protect banks over time. And what happened when we created stablecoins? Well, at the top of that structure is debt gets created. At the bottom of it's people have money that they use to move around in dollar terms. Stablecoins collapse that all those intermediary steps into there's debt that gets bought by stablecoin provider, and people trade the stablecoin as money. So that's disintermediating, collapsing so many things in the banking system, to the point where, the Community Bank Association in the US wrote this letter when they were passing regulation around this year. It was called the Genius Act. And they wrote this letter to the regulators saying, you cannot allow stablecoin providers to have a Federal Reserve master account, because if they do have that direct account at the Fed, then we're going to get disintermediated, and it's going to uplift the banking system, because people are realizing it doesn't make a ton of sense. All we're really doing is trading around the debt of the government. That's what we're doing when we're trading around dollars, and all we need is a layer that really makes it fungible. And what I mean by that is, the reason, like, when you think about that question, it's like, okay, well, Treasury securities, they pay some sort of rate of return. Why wouldn't I just have Treasury securities earn interest and then pay people with Treasury securities? And the main reason is because they're not fungible. So one Treasury security is often very different from another one. It was issued at a different date. It has a different maturity. It has a different interest rate. Has all these different differences in the terms of it. So what is stablecoins effectively doing? It's blending all those securities across to make them like for like, to make them more fungible in a stablecoin pegged to the dollar. So that's why you kind of still need that layer and why you're not trading it directly. But the really interesting thing is that stablecoins are going to be paying a rate of interest, at least internationally. And to understand the key dynamic here, you have to understand what happened with the Genius Act when it got passed back in August this year. And it did two primary things. The first thing being, it said banks or stablecoin providers are only allowed to use short duration government debt in their reserves. And that was big, because there's a lot of things that stablecoin providers have been using. They've been using short duration government debt, longer duration, commercial paper, and Bitcoin. So keep that in mind. That's the first one. And then the second one is that they didn't allow stablecoin providers to pay a rate of interest. So that meant that unless you have a bank charter and you're issuing a stablecoin in the US, you cannot pay interest from your stablecoin to anybody that's holding it. Well, all that is regulatory ring fencing so that banks aren't outcompeted, to the point I was making earlier. They're trying to say okay, well, only banks can do this because of this law. And that still allows banks to have some sort of competitive advantage over stablecoin providers. So what are banks going to be doing? They're issuing something. It's kind of like the new version or the new word for a CBDC. It's called a tokenized deposit or a tokenized reserve deposit. JP Morgan issued one on Ethereum layer 2 blockchain base. It's just run by Brian Armstrong. And that's kind of like a beta version of one of these, but we can expect more of that to happen amongst the banks, where it's it's the same concept as a stablecoin, but it pays you interest, kind of like a money market account. And so what's happening with all of that context? If we look at Tether, far and away the most dominant stablecoin over time. Tether's reserves have been in, government debt, commercial paper, which is corporate debt, and in Bitcoin. So most recently in their attestation, they had 5% reserves are held in Bitcoin. And that's really interesting. So when we think about what Tether was going to have to do, and we wrote about this in the report, is that Tether had a really big decision. Now that the Genius Act got passed, they can't hold their reserves in the same way. So one, they either change Tether to be in compliance with the Genius Act regulations in the US. Two, they go completely offshore and don't operate in the US. Or three, they create two different versions of Tether, one that's US compliant and then one that's compliant in the way that they've been operating historically. And what we've witnessed within the past few weeks is that they've launched a US compliant stablecoin now, USAT. And that's something that's abiding by the Genius Act regulations. So what's happened now that they've done that is they've created effectively an onshore and an offshore market for stablecoins. And that's where we see a lot of similar to how money, what's always happened with the dollar. We've had onshore and offshore market versions of it with the euro dollar system, things that are kind of outside the control of the US, compliance and regulation and systems, but yet still exist and represent dollar denominated value in the international markets. We kind of view Tether as becoming like this offshore version of the dollar. And what we expect is that, everything's going to be compliant within the US. But in the offshore market, we're going to start to see that all these stable coins are competing based on paying a rate of interest to people. That's what we're going to start witnessing, is that while the US might say only banks can do that and the banks can compete on that, and that's going to be, not great for stable coins out here, and it's going to put the US behind on innovation. In the offshore market, they're going to start paying a rate of interest. And when we start to see that competition among stable coins paying a rate of interest, it creates a really interesting question. What is the best reserve I can be holding to optimize, my dollar peg, as well as to pay the most competitive rate of interest onto, the people that are trading my token. And that's where the question of Bitcoin gets really interesting in this whole conversation. As Tether has been holding 5% reserves in Bitcoin, how will that expand over time? And when we think about it, what is that best reserve that's going to allow the most competitive rate of interest? And then that brings up this question of, well, what happened with Michael Saylor when he issued this stretch preferred equity product this year? And we're effectively creating something that's mimicking and competing in the market of like short duration debt, and it's paying a 9% interest rate. And he's fully collateralizing that with just a Bitcoin backing effectively, or not reserving necessarily directly, but he's paying the interest based on, the expectation of Bitcoin's capital appreciation. So we view Stretch as kind of like the proto version of where the stablecoin market is going to start going over time. Like the Stretch product is cool, it's just not in the right rails. You buy it as a stock in your brokerage account. If you could buy it in a way that was traded peer-to-peer, like money amongst people, we kind of view stablecoins gradually increasing their reserve allocation into Bitcoin over time. As Bitcoin matures and becomes more stable, it becomes more viable for them to do so. And we expect Bitcoin to start to expand in the reserves of like the offshore dollar market. So like to bring this all back around to this disintermediation question, it's like we have banks with all this intermediation, we have stablecoins collapsing a lot of that intermediation. Then we have Bitcoin. And it's like stablecoins are creating this efficient disintermediation in the market. And then we're going to feed Bitcoin to people through the reserves of this market in a way that allows them to gradually get exposure to it over time and not take on as much risk. And maybe they know it, maybe they don't know it as much. All they know is what people are good at knowing is, what yield am I getting on this? And if they don't understand that Bitcoin's the thing producing that yield in the background because it's this valuable, scarce commodity, I view that as kind of bullish. But like that's the point, is that as long as Bitcoin continues to be a valuable, scarce commodity, as long as it's competing well as money, then it's going to be an incredibly valuable reserve. And we're witnessing this shift where banks supporting these types of technology, it's going to start putting people off the rails of trading and transacting in all these different fiat systems, like the SWIFT international settlement system, and ACH is a domestic US payment system, and credit cards and applications and all this whole layered banking system we've built out. We're switching from that to, when people start using stablecoins for payments, just using a cryptographic signature. And when you sign a cryptographic signature that's representing some sort of value, now everybody's getting onto that rail of paying for things with cryptographic signatures. And that's what we want, because the difference between you paying for something with a bank account versus you paying for something with a stablecoin is really meaningful when it comes to Bitcoin adoption, because The step from paying for something with a stablecoin cryptographic signature to Bitcoin, that's the flip of a switch. The step from paying for something with a bank account to Bitcoin, well, you got to get out of the bank account, you got to get onto the new rails, and it creates all this friction for people to actually switch over. So it's a great next step to get people on the right rails. And then as people realize or don't realize and just naturally gravitate towards because they trust other people that are doing it, that Bitcoin is the best form of money and it's better than dollar denominated assets, people will just naturally start paying for things in Bitcoin once it's on these cryptographic rails, and it's just a flip of a switch away. And I don't think that happens from a bunch of people saying like, oh, I want to pay for things in Bitcoin because I like Bitcoin. I think it happens from people over time saying, no, you need to pay me in Bitcoin. It comes from the person who's selling things and saying, I could accept stable coins and I could get this X percent of interest, but I just realized that all this interest that's being paid out to me, the stablecoin provider has been taking a huge chunk of it. They're making all this money from holding the Bitcoin on the back end, and I'm getting paid like 8% of it. And it's been going up 30% a year for the past 5 years. So why don't I just trade Bitcoin directly, and why do they get to keep all of that? And I think that'll be one of the primary incentives that starts to cause like downstream demand for Bitcoin payments. This is all like much more long term, and a lot of things need to happen along the way. But like that's like the really big thesis around all of this and how all this stuff really ties into Bitcoin.
That's fascinating. So if I summarize it really quickly, so I understood it, is like we now have this fiat system where central banks hold gold in the reserves. And then the next step would be kind of like stable coins, slowly backing things with Bitcoin. And then the final step is like people just use Bitcoin. Like
right. And all the stage will be set for that to be so much easier because the software provider that their local merchant is using is already going to be accepting stablecoins for things. And that same software is going to be very easy to switch over to just accepting Bitcoin. And that's going to make it 10 times easier for people to say, oh, well, I'll just accept Bitcoin. It's just a different type of cryptographic signature I'm accepting payment for. And then people are going to be like, well, yeah, I want Bitcoin because I've been watching it go to $1 million, and I know that it's what's backing all these stable coins I'm accepting right now. Why can't I just, have it directly so they don't get all the money and I get some of it?
And we often talk about like where Bitcoin is going and like what is kind of final thing. But I think we like don't often enough talk about like the path towards that. Like we're like, oh, like Bitcoin is going to 10 million, 20 million, like it will suck up all the energy. But then it's like interesting for me, like, there's a long way to there. It's like we're now like a small $2 trillion asset, at $10 million. Like Bitcoin is a huge chunk bigger than right now. And now this is like 100. Is it 100x from here? Yeah, of course. Like it's a 10x to a million and 100x to kind of like 10 million. It's massively bigger. And I always have this chart in my mind, like with Jesse Myers having like this, I think it was $1,013 trillion assets in the world, where Bitcoin is just like the small dot with like $2 trillion, like gold $22 trillion and all of that, all of the rest of it. And I'm like, how the heck do we get there? Because I still see so many people just like, oh, I don't want to deal with Bitcoin and all of that. And I think this indirect way with stable coins and this indirect way of like using Bitcoin, not directly, but indirectly as a first step towards makes a lot of more sense to align incentives, I guess.
Yeah. And like the way to think about that with any complex system, right? With moving from one complex system to another, you need bridges, you need scaffolding. You don't build a skyscraper without scaffolding. And like that's how we view a lot of these things. It makes it a lot easier for people to switch over. And that's becoming, very apparent to people right now. And it's great for people that go direct. Very few people in the world are in a position to be going direct or care or have the relevant knowledge to. The vast majority of people that adopt Bitcoin are going to have no idea how it works. And they're not going to know anything about the history of money. We're this weird early group that was the innovators and, the risk takers who decided to learn it fundamentally and make it what it's to become one day. But as Bitcoin becomes what we know it's going to become, it's just going to be adopted because how people adopt everything, they're going to look at heuristics and social proof, and they're going to say, well, my dad has owned Bitcoin for 15, 20 years, and he told me to do it. And, I've always been told that it's good to own your home, and it's good to invest in stocks, and it's good to save in Bitcoin. And like, people are going to start thinking like that over time. And that's how the majority of people are going to start entering this, at least within like a developed economy. And the developing world will be completely different. People are going to start being like, the money that I hold in Bitcoin is the money that can't get stolen from me by hyperinflation or by, dictatorial governments. And they're going to have a completely different reason from doing it. And they're probably going to understand some of the permissionless abilities of Bitcoin much better. And there's all these different ways that people will perceive it and just be like, oh, this is just like the thing I can use that other people can't control. And that's really cool. But yeah, I don't expect most people to really think much at all about why it's valuable. I expect the vast majority of users to come because other people that they know and trust are using it already.
I get that. It's super interesting to talk about that. It's like it almost sounds like at first like banking report sounds for Bitcoin, I think, at its face value so boring.
Yeah.
And then you're like, okay, well, like, what actually does this mean? And it's super interesting, in my opinion, at least, for Bitcoin. Is there anything else like, that came out of that, like, banking report that we haven't touched on that, like, is super important to, like, notice?
Yeah, it's 150 pages. There's a bunch of great stuff in there. Some of it's built for like people who are like bank executives and not for your normal investor reader. So it's a pretty serious report. But in terms of some of the other, we had like a series of predictions that we made about the market in it. I think another area that's pretty interesting to people is going back to the original point you were making on Bitcoin treasuries and how those will kind of move towards like bank-like type functions. The big thing that we see with Bitcoin treasuries is that, they're all going to be competing against one another, and they're going to have to justify why investing in their entity that owns Bitcoin is better than whatever their direct competitors are. And their competitors will be other Bitcoin treasury companies, on their similar exchange. And there's a few different ways that they can differentiate. One is through capital financing, and whoever has the most competitive advantages at that, which is, today MicroStrategy and Metaplanet. And Metaplanet also has a competitive advantage in the tax environment of their country. And so that's like the big boy game. Not a lot of people are going to be able to do that well. And the ones that do it are going to capture a lot of the market. And then there's going to be like the operating model. So like, do they do anything else other than own Bitcoin? And if they do, how synergistic is that operating model with owning Bitcoin? There's some operating models that have no relation to Bitcoin. And there's no way you could actually use Bitcoin in the business itself. There are some that are like Bitcoin companies, the type of companies that, like our fund invests in, that they need Bitcoin liquidity for a lot of different things. So if you already have a business related to that, we know that some of the treasury companies are like thinking about, how do we, buy a Bitcoin business that'll be beneficial to our Bitcoin stack. And you can use your Bitcoin to supply liquidity to the company and ultimately earn more profits and have a cheaper source of liquidity for the company because you own it. So there's a synergy that you get from having an operating model that needs Bitcoin and then owning a large Bitcoin treasury. So that's another way to differentiate. And then I guess one last point I'll actually make on the operating model. It's a really challenging question right now because every dollar that you have that you're putting into a business that gives you that synergy is a dollar that also could have just gone into Bitcoin. So your opportunity cost of capital on owning that operating model is what the capital appreciation of Bitcoin would have been otherwise. And so people are going to have to justify, okay, we want to own this business, and the synergies we unlock from owning this business with our Bitcoin stack is more valuable to us than just owning Bitcoin itself. And that's the most interesting thing to me, because that's what, we're thinking about a lot as a business. And I'm really curious to see what we start to find from some of these companies related to that. And so the third way, and I think that this will be the most common way that these companies differentiate, is by earning some sort of rate of yield on their Bitcoin directly. And not every Bitcoin treasury company is going to become an asset manager, because that's what you're doing. You're managing an asset, you're earning a rate of interest on it. And there's ways that you can do that natively with Bitcoin that you can't really do in other areas of finance. And that's because they're specifically related to technologies that Bitcoin interacts with. And Nick Bhatia kind of theorized back in, I think, about 2018, this idea of a term structure of interest rates that's distinct for Bitcoin. And we have this like new native capital market. If we believe Bitcoin is the foundational money for the world, in the same way that the US dollar has a term structure of interest rates, Bitcoin has its own term structure of interest rates. And what I mean when we say term structure of interest rates is just there are foundational interest rates that we look at for the US dollar today. And people have, commonly heard of the risk-free rate, and that's your shortest duration US government debt. And that's at like the bottom of the curve. That's at the beginning of the curve. And we say that's the quote unquote risk-free rate, which we all know is bullshit. And all that risk is happening through inflation to us. Every time, the government's printing money to pay for money, it's effectively going bankrupt, and we pay for it through inflation. That's what risk-free rate means. And then when you move up the yield curve, there's other forms of longer duration government debt on this term structure of interest rates. And those have higher risk because they're longer out, and you know what the expectations are, et cetera. So we have something similar that's emerged on Bitcoin, where at the bottom of our term structure of interest rates on our like Bitcoin native yield curve, we have things like, at the bottom, it's like self-custody. You don't have anything. That's like the closest you can get to risk-free, and that's still not perfectly risk-free. You can lose your Bitcoin in self-custody. But then you could put it into something like earning routing fees on the Lightning Network. And just by like committing some Bitcoin to earn routing fees, you can get a capital return on your Bitcoin in the Lightning Network. You can take a little bit more risk, and you can start liquidity leasing that Bitcoin into the Lightning Network as well. So there's like two types of fees you can earn from just putting liquidity like Bitcoin into the Lightning Network. These are like very low risks, at least from like a financial standpoint. Operationally, it can get more complex. But those are kind of like more towards the bottom. And then we have things like other things that are emerging. There's another protocol called ARC, and that's going to need liquidity. And then there's going to be fees that people can earn by running an eCash mint. And then there's going to be other things like zero knowledge rollups, and those are going to allow you to stake your Bitcoin into these protocols and earn some sort of inflationary fee on that. So there's all these different ways you can take Bitcoin and earn interest in ways that you can't really do with any sort of traditional asset. And then you can even do it in traditional ways. You can lend Bitcoin, which we suspect the banks are going to be doing. And there's a bunch of other avenues that are like in traditional form, whether it's secured lending or unsecured lending, and et cetera. So that builds us this like yield curve. And all these Bitcoin treasury companies are going to be looking at this yield curve and determining how much risk they want to take on this curve and what type of yield they want to be earning. And to do that in all these Bitcoin native ways is going to be really complex. So what we suspect is that not every treasury company is going to be doing that. Not everybody's going to have the proficiency to do that. There's very few people in the market today that really know how to do that. There isn't like a best practice. Nobody knows what this like optimal way of doing Lightning liquidity leasing is yet. We're all just kind of learning. So there's going to be really specialized firms doing this that are like, we can get a much higher interest rate because we know what we're doing technically in this, and we're going to participate in some of these new networks, and we have the technical ability to assess things as they emerge in a new way that you do not. And what does that mean? All these Bitcoin treasury companies are going to start getting their Bitcoin and giving it to these asset managers that are earning them a yield. And then they're going to get their yield, and then they're going to go tell the investors in the treasury company, hey, we got, this return on Bitcoin capital this quarter. And so we suspect that there's probably going to be a decent amount over the next couple of years as that process starts to unfold. We'll see more concentration of the Bitcoin into some of these asset managers and control over it through custodial providers than in the actual Bitcoin treasury companies themselves. And that's going to be kind of like the bank-like function that they're ultimately fulfilling. They're taking in Bitcoin from raising capital from their investors, and then they're going to go earn some sort of rate of return on it. But yeah, so that was kind of one of our interesting predictions from some of it.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They're also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use simplemining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. Again, that's microseed.io to get your last backup tool you ever need. That is interesting. And there's so much with banking and Bitcoin, because like on the one side, I fully understand like the stablecoin side of things. And then also like, I mean, I'm not at any, like, I'm probably not very representative of the normal user. I now, except Bitcoin, I have probably 70% of the income through that podcast completely in Bitcoin. With the business of Microseed, I don't think it's more than 30% that actually comes in with like, because it's B2C, that like how many people like buy directly through Bitcoin, even though we do everything with a Bitcoin provider, but they also like handle the hard card payments and all of that. And then I also try to like pay people in Bitcoin. So like my freelancers and all of that. And I use more and more just like a Bitcoin account, and it was interesting. I was on a crypto channel as the Bitcoin maxi kind of, and afterwards the guy asked me, "Oh, like how do you handle their finances with people all across the world?" And I was like, "Yeah, Bitcoin." And they're like, "Oh, why don't you use stablecoins? Like it's so much better." And I'm like, I don't know. I don't even want to do that. Like, I just want to be with Bitcoin. Like, why would I like change my Bitcoin to stable coins, like change it around, like transact? Like Bitcoin is super easy. Like it's just, there's an address, like I send it and I receive it. Like I do it even on chain. Like I don't do anything on Lightning currently because the fees are so low. And if you transact for like, I don't know, like, $500 or $1,000, like paying 70 cents for that transaction, like I don't care. It's like nothing. You pay a lot more if you give someone in El Salvador $1,000 over the traditional financial rails from Austria than like 70 cents on the Bitcoin layer. So I'm really curious how you feel like the mean of exchange side of things of Bitcoin will progress. I mean, some of the things we already touched on with the stable coins, but how do you see currently like the mean of exchange side of things for Bitcoin?
So a big part of our thesis is for like our fund is the way that we view it is there's like three primary cycles of Bitcoin adoption. And we view those cycles to be aligned with its adoption for different functions of money, uh, each kind of building on top of one another. So when we think about how money has just been adopted historically, it's not that everybody wakes up one day and says, I'm going to use this form of money now. When money was adopted in private markets, it's something that would naturally progress through different stages and eventually become something that everybody was using as money. And stage number one is it a good store of value? Because without being a good store of value, it's hard for everybody to want to own it in the first place. And that's like a really key ingredient. I think when a lot of people criticize Bitcoin, who are like traditional economists, will say, well, most of the other goods that were used in primitive times, they had some sort of utility. And because they had some sort of consumption utility, a lot of people own them. So in like agricultural societies, when people owned cattle and people owned salt, these were just very common goods that everybody was using all the time. And then they ended up using those two goods as money because everybody had them. Everybody always had a demand for them. And that's kind of the argument against Bitcoin. And what we argue for is that, well, no, it's kind of two factors. What makes people want to own something? And it's kind of two factors that makes people want to own something. It's either its consumption value, which is what we're describing with cattle and salt. People wanted to eat it. People wanted to put salt on the meat. Or it's the monetary value, being a good store value. And a lot of people would just own assets because they were just scarce assets. And that's how we saw precious metals get adopted, like gold and silver, is that they were the scarcest commodities in the world at that time. And that made them something everybody wanted to own because we knew the supply of them wouldn't drastically increase. And so that's something that allows money to slowly become something that everybody owns. And that's the phase that we're in with Bitcoin right now is we're consuming the market of the store of value. And that means we're getting everybody to own some Bitcoin. And the second everybody owns Bitcoin, that's when, or at least the vast majority of people, that's when things start to get really easy when it comes to thinking about it as a medium of exchange. Because one, at that point, so many people are going to own it that the volatility has decreased so much. And two, everybody's going to be familiar with it. Everybody's going to know how to transact in it because they own it in some way, shape, or form. And that greases the wheels and reduces all the friction to using Bitcoin as a medium of exchange. So like we're in this S-curve market right now trying to capture this whole store of value market. We view that as a longest adoption cycle. The second that happens, the other two cycles will be more rapid. And then that means it's going to be used as a medium of exchange. And people all just start saying, okay, well, all of us own Bitcoin. Bitcoin's kind of how we're saving our money now. And I just pay me in Bitcoin because I want more of that because this is like my savings payment basically. And pretty much everybody I know also accepts it. So it's really easy for me to just like pay for something else in Bitcoin. And that's when we're in this medium exchange cycle where, to the point I was making earlier, a lot of the people that are selling things are going to be the ones saying, pay me in Bitcoin, not in dollars, not in whatever else. I want direct Bitcoin because I know its value. And then while that happens, it's like, okay, well, we're all just starting to pay each other in Bitcoin. Why don't we just start denominating everything in Bitcoin? And that's the final cycle of it consuming the unit of account type market of money where people actually start accounting for everything and structuring prices in it. And the second that happens is when we get true price stability. Once people are denominating their assets in it as a unit of account, that's when Bitcoin becomes this stable monetary asset. The same way gold was used to price everything at one point in time. So that's kind of how we view the adoption cycles happening. But the store of value phase is still a long ways out. You know, there's arguably a few 100 million people in the world that have some sort of exposure to Bitcoin right now. And it could be a lot less. It's just like a lot of assumptions we're looking at. But there's quite a bit of room in terms of the amount of people that haven't been exposed to the market yet. Because even of the people that have exposure, most people have a very small amount of exposure. And a very small amount of people have a large amount of exposure in terms of their personal wealth. So there's so much more to go until like 60, 70% of the world owns Bitcoin. And then once that happens is when we're getting a lot closer to like, okay, so now everybody's kind of familiar. It's really easy for people to start trading in it because we all just own a little bit and kind of get it.
Super interesting. Do you have any like kind of like timeline on that? Like anything like how long those like adoption cycle
I think the
usually like.
store value adoption cycle is going to be going for the next 5 to 10 years, and that seems like a pretty reasonable amount of time. If we look at the progression of Bitcoin historically and how rapidly it's grown through adoption, even with diminishing returns, 5 to 10 years is plenty of time for that rate to continue, and then to ultimately capture probably a majority of global population. We'll have to see. It could be there's a million people with a million predictions about this type of stuff, and nobody knows. But that's kind of how I'm planning for it. Like with us being a venture capital fund, when we're investing in companies, we're looking at companies that are building things that help people use Bitcoin as a store of value today, because we view that as just the most important thing to be building for right now. Like if you're building a company that's designed around Bitcoin being used as a medium of exchange, it's going to be a lot harder for you to find users, and that's you might be putting the cart before the horse in terms of this is just too early. There's a lot of good ideas out there, and one of the big problems is that a lot of times people are too early with good ideas. It just wasn't the right time in the market, and so like when we think about it in terms of like our fund, we're thinking about it on like a 5 to 10 year time horizon for a lot of the store value adoption happening, and what types of companies are going to benefit from that is companies that allow you to buy Bitcoin, allow you to hold Bitcoin, allow you to take loans out against Bitcoin, allow you to do international payments, all these different types of things.
Super interesting. What is actually, I think I haven't the second podcast, and I haven't really asked you about the venture capital fund. What are you guys doing, and like what are you kind of focusing on? I mean, we had it in the beginning, I think a little bit.
Yeah, like so our big mandate is focusing on Bitcoin adoption, and like we don't think we're like smarter than the market on anything. We're waiting to see what emerges related to all the different opportunities. But like, what's the North Star that we guide ourselves by? Is this company idea, software protocol? Is this forwarding Bitcoin adoption in some sort of way? And our thesis is that there's going to be very high return ways of getting exposure to that. So like a really good example of this would be a company that's getting into lending. The value of a lending company where they're earning fees based off of giving people loans, and there's this perennial demand for people that want to take out loans against Bitcoin because they don't want to sell their Bitcoin. They would much rather say, okay, I'll pay a smaller rate of interest in the near term, and then I get to keep my exposure to the upside over the long term. Because Bitcoin's such a high appreciating asset, and because we have a massive global cult following of hodlers, there's a lot of loans that people want to take out against it, so they don't have to sell it. So we have this market that's already highly attuned towards doing that. And what makes a lending business grow? Well, the value of the asset they're lending against, the collateral, grows. So as the price of Bitcoin goes up, the value of the assets any sort of lending business is dealing with goes up. Its market just starts to grow. And then we also view that the percentage of lending in the market is a lot smaller than what it'll be naturally over the long term. In that banking report I mentioned, we had some numbers to kind of show what that could look like. And so we think also lending is just going to expand more as a percentage of the total amount of Bitcoin that exists. And that market is just very infant right now. So like not only are you growing with Bitcoin, but you're growing with the size of the loan market as well as it grows in proportion to Bitcoin. And then you can earn fees not just from, issuing loans, but you can earn fees from, the second it gets called. So even during a time when Bitcoin is not performing well, like a lending business is earning a lot of fees from loans getting called in, and then they're getting the collateral too. So like there's businesses like that that can do very, very well. And, it's our job as like investors to look at these things and make the right decisions, and on a portfolio wide basis, how well can some of these things do? But we're really looking for that. We're like, it's kind of akin to like with a Bitcoin treasury company when they say it's like a high beta version on Bitcoin. It's like we're looking at that, but in financial theory, the private companies we're getting exposure to that we're looking at in terms of being like a high beta play on Bitcoin. Another big advantage you have with dealing in private markets versus public, which is like where Bitcoin treasury companies trade, is that in private markets, in financial theory, it's called an illiquidity premium, is one of the things that you're getting compensated for. So because a private market is an equity ownership in some sort of company, but there isn't an exchange to go sell it on, it's not as liquid. There's no liquid market. And the reason for that is that, we have certain standards that a company needs to be this big and it needs to meet these types of, financial metrics and abide by these rules and regulations in order to list on a public stock exchange. Companies that are much earlier or choose to remain private, they don't have those benefits, but they get to do a lot more of what they want to do, and they don't have to abide by these regulations. So in startup land, because it's very early and because they're in private markets, there's a premium that you get because there's a lot more inefficiency happening in the private market. So a lot of the value that you can find, and one of my, basically since I've been in college and I studied finance, was that I always wanted to work in private markets because that's where the majority of the inefficiency lies, which means that's where you have the best chance of getting an advantage or having some sort of alpha that you can find. And a lot of that really happens through network, like particularly in our world, it's knowing a lot of different people, knowing the right companies to talk to. Things kind of like that. So like it's like a high beta play on Bitcoin and has a bit of an illiquidity premium. And like that's kind of the thesis that we're working towards on the fund.
Love that. That's really interesting because like I think a lot about the amazing time that we are currently witnessing with Bitcoin. I think it's it's a massive gift that we kind of lived through this Bitcoin evolution so early on. That kind of Bitcoin happened within our lifetime, especially for everyone that is now like under 50 years old or like maybe like under 50, like whatever the thing is. You will see the pre-Bitcoin evolution and you see the Bitcoin evolution, and you kind of see how this all plays out in the very early stages. And I don't know about you, but like I feel like in hundreds of years, like they look back at like this time frame of like 2009 to like 2050 of like being extremely revolutionary when it comes to finances and money in general because of Bitcoin. And I just feel so grateful and lucky to be in this time frame and to being able to document that and being able to like have companies in there and like being kind of an active participant in there. It's like everything that we are doing in Bitcoin is like super exciting because of that. Like, oh shit, like people will look back as like, oh yeah, there's like was this one podcast, like this thing, there's like this company. Like I'm just super excited about that frame.
Yeah, I couldn't agree more, man. It's like I think when I got involved in this industry, I just felt like it was like built for me. It was built around all of my natural interests and everything that I was guided towards. And yeah, I have to like it. Well, it's funny because what I realize now, and the best way that like you start to forget about it, because I've been working in the industry for about 5 years now, and you start to forget, just how lucky you are. Like I get to wake up and when I wrote my book, it was like the conclusion I came to is what's the biggest problem for Bitcoin? It's like it needs more infrastructure built around it so that it can expand more into becoming not just a store of value that people hold through some sort of like ETF account, but it's something that can be used more as money. And that's the biggest thing that will unlock the market size of Bitcoin over time. Without that infrastructure, we're not going to unlock that market size. So I was like, what's the biggest problem to make it global money? And the big vision is that Bitcoin needs to become the first neutral monetary asset in history for, being used globally. And like the only way we achieve that is with infrastructure. And I'm like, okay, well, cool. Well, I get to, work on trying to solve the biggest problem that I view in the world right now, because I think that if we achieve this vision, if we create a neutral monetary system, it's going to change how society is structured. It's going to mean that governments have to adhere to an austerity. They're going to have to adhere to a standard of fixed monetary behavior. And that's going to change their ability to finance things that people do not want them to finance. And that's going to change how much war is happening in the world. And it's going to change the incentives of global politics. And like, we can't even comprehend exactly, how utopian this vision might become, but it's the most exciting thing I can possibly imagine. It's also something that, everything I'd learned about and thought about before getting into the industry was aligned with. And that's why I was able to get Bitcoin, because of that. And then it's like, yeah, I get my job is a dream job. I get to work on these Bitcoin companies all day. And it's most apparent to me when I talk to people who either like work in the area that I used to work in or have some sort of like other corporate job in professional services. And I'm just like, yeah, I can't even imagine doing that anymore. My life's just too good doing all this Bitcoin stuff.
I was before Bitcoin, I was an account manager, which basically meant I made Excel sheets and PowerPoint presentation for a living, and it was so it was not bad. Like I loved my coworkers, the company was cool, but honestly, it was just like not creative enough and not exciting enough. The whole industry also like I'm very happy to do this now. I have one question for each and every one of my returning guests. And the question is, what have you learned outside of Bitcoin since your last appearance?
I went down a whole health rabbit hole this year. I learned about hormones and testosterone, and basically, and it's funny because I think this is all really obvious to people in Bitcoin because so many of them are down this rabbit hole. It's kind of stuff that I would normally like ignore as long as I feel good. It doesn't matter. But yeah, I learned about how screwed up food is, and it's actually like really hard to eat food that is healthy. You have to really go out of your way to not screw your system up. And I turned 30 a couple of years ago, and I think ever since that point, it's like you can get away with all these bad habits in your 20s, but get into your 30s, you can't get away with it. It starts to impact your health more, and it was like making me like feel tired, and I wasn't sleeping right, and there was like something wrong with me. And yeah, I went down this whole health rabbit hole, and I figured out like, oh, I actually need to eat a balanced diet. And I balanced the diet out, and it was just crazy how night and day it's like changed how I feel, like, my ability to focus, and I'm so high energy, and I don't get tired in the afternoons anymore just from like learning how to focus on my health in the right ways. So that was super cool. That was a period of like 3 months. This is Adam behind us. He had to listen to me talk about my testosterone to people for like 3 months while I was learning about all this stuff. So he knows the drill as well.
Yeah, like, people closest to you always get exposed early to the rabbit holes, I guess.
Yeah.
Really cool. Thank you so much. We have an end routine, as you know, as you might know from the last time, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you the question. It's really interesting. It's a very fitting question actually to what we have already discussed. Do you believe Bitcoin is an appropriate central bank reserve asset? Why or why not?
Oh, cool. Yes, I do. And so a big part of this banking report and the way that we expressed what Bitcoin is, so that people in the banking system can get it, is that if you look at how the system works today, from the bank's perspective, we have commercial banks that all have, accounts. They have a Federal Reserve master account at the U.S. Federal Reserve, and then if one commercial bank that has a master account wants to send money to a bank that doesn't have a master account at the Federal Reserve, then but might be, say, like an English bank that has an account at the Bank of England, they have to go through a correspondent bank that has accounts at both, and it allows them to like settle and move money between all those. So we have this like quote unquote correspondent banking system that exists. And if you look at that, you realize that of the market of, payment, like of central banks that exist right now, from the eyes of a bank, there's all these different central banks around the world that they have to deal with to move money around. And what makes Bitcoin distinct is Bitcoin basically is just the same thing to them, except for it's the only one that's neutral. All these other ones are kind of the same, with the US far and away at the top. And then Bitcoin's the only neutral one. And it's the only open one, where all these other ones, to interact with it, you have to go request an account to get there. And vast majority of people don't. Only a handful of select banks that are, meet the requirements as well as are like on the inside are able to actually accomplish that. Bitcoin's the first one that's open. So like, what does that tell you? All these banks are just going to want to link up to it as a central bank over time because it's easier to move money over it. It's the only one that's an open network. And because of that, it's going to create a massive network effect amongst these banks wanting to use it. Is like, rather than going through a correspondent bank, they'll all start just like moving Bitcoin over the Bitcoin network with one another because they can openly access it. And not super interesting. So it's like, is it a good reserve asset? It's like, yeah, I think we're going to see in the market that it's going to start being demanded like that in the not too distant future, because it's the only neutral central bank asset that they could be settling in.
I love that. And it makes if you think about that, those first principles that you kind of talked about, like it makes a whole lot of sense.
Yeah.
Like just like adopting Bitcoin. Thank you so much, man, Eric, for being on the podcast. Before I let you go, where can people find you and all the stuff that you're doing?
Yeah, you could check out my firm at our website. That's epochvc.io. And then my name on Twitter, Eric Yakes. You can just follow me there and send me a DM.
Awesome. Thank you so much for being on. And also thank you so much for everyone that is watching and listening for joining us today. As always, I'll be back tomorrow with another episode. Bye-bye. This content is for educational and entertainment purposes only and does not constitute financial advice.